Professor Dr. K Durai Pandian, Head of the Department of Commerce at Amet University, Chennai. Last semester, we have been taking admission and retirement of partners. So this semester, we are going for dissolution of firms. So shall we go in for that? The financial accounting is the topic name, and this is for the first semester and second semester topic. Yes, today we'll take up the dissolution of firms. Dissolution of firms are of two types, namely simple dissolution and insolvency. So we take up the first one, simple dissolution now. And the simple dissolution of partnership, what takes place? So dissolution means closing down of the business. Closing down of the business. So normally when the business will be closing down, when it is not running profitability, and when the partners are not willing to run the business continuously due to heavy loss, and suppose when there is no demand for their product which they are manufacturing or which they are dealing or trading, so they want to close down the business. So that we call it the dissolution of business, closing down of the business. So at the time of closing down of the business, already we have seen in the last semester that at the time of admission of a new partner, at the time of retirement of a new partner, at the time of death of a new partner, what are the procedures to be done in the accounting process? So in the same manner here, in the partnership firm, when they want to close down the business, so what are the procedures in accounting concepts? What are the steps that are involved in the accounting process? Because any business, as a matter of fact, whether it is a sole trader or a partnership or a joint stock company, so they have to maintain the books of accounts for the sake of government, for the sake of stakeholders, for the sake of employers, so on and so forth. So for that purpose, we have to close down the business also. At the time of closing down of the business, so we have to maintain, these are the minimum ledger accounts. Normally, these are the steps involved for closing down the business. That is preparation of realization account. Preparation of realization account. Realization account. And number two, preparation of capital account. Capital account of the partners. Capital account. And finally, the bank account. These are the necessary ledger accounts to be prepared. Necessary ledgers to be prepared and closed. Preparation of realization account. So at the time of admission and at the time of retirement or death, we prepare revaluation account. So the assets and liabilities are to be revalued. Whereas here, the assets and liabilities are to be settled. That is, assets have to be realized and the payment has to be made. The liabilities have to be paid off. So that is why we prepare the realization account. Then we have to prepare the capital accounts to find out what is the amount to be paid to the partners and what is the amount to be received from the partners. Depends upon the capital position, whether they have a debit balance or a credit balance. That depends on the availability of the money in the business. Then finally, setting down the bank account, closing down the cash. Suppose if the cash is settled down, the accounts are closed. So here we don't have any balance sheet and all that. You'll be given the balance sheet. With the help of the balance sheet and the adjustments relating to realization of assets and payment of liabilities and expenses and realization, so on and so forth, then we'll settle down the business. We don't have to prepare any balance sheet after this because there is no accounts at all. Everything is closed. So one by one we'll go. What is the specimen of the realization account, how it is transferred to capital account, how the capital account is closed through bank account. We'll take up. First, preparation of realization accounts. The specimen of realization account I'll show you. The specimen of the realization accounts. Specimen of realization account. Realization account. So you open realization account. So now the purpose of this concept and this chapter is closing down the business. That means we have to close all the accounts. So already you know the basic concept of accounts. So if you want to close down anything, we have to give the opposite effect. If it is a debit balance, you have to give the credit, and if it's a credit balance, you have to give the debit. Automatically, the accounts are closed. So on the realization account debit side and credit side, so we have to transfer all the assets of the business. Transfer all assets. So when you give credit to the assets, the realization account data to assets, that is a journal entry that we pass. If you want to pass the journal entry and post it, it is like that. To close the assets, we pass realization account data to assets, credit all assets. So when you debit whatever the amount may be, building, land and building, plant and machinery, bills receivable, what are sundry data, these are all assets of the business. If you want to close down all the assets, we have to give the credit, so automatically it gets closed, all the book value. That this is to be taken from the balance sheet. The same manner to close the liability side. This is except bank. Close assets except cash and bank. Except cash and bank. The same manner to close the liability side. Liabilities, that is except capital. Because for capital we are opening a separate account. Except capital. So this we have to give the opposite effect. All the liabilities are credit balances. So if you want to close the credit balances, we have to give the opposite, debit it. So debit all the liabilities. So liabilities account data. Liabilities account data. Liabilities in the sense sundry creditors, bills payable, OD, like that. To realization account. Realization account. Here we are transferring except capital. Capital should not be transferred because capital is closed in a different manner. So thereby we are closing all the assets and liabilities of the business. So now post it in the realization account. To transfer all the assets, book value. Book value. In the same manner, transfer all liabilities. By transfer all liabilities of the business. So thereby it is closed. Book value. Book value. So thereby we close the books from the balance sheet. Now these assets have to be realized. We have to sell the assets. Because out of the sale process only the creditors have to be paid and the capitals are to be paid. So therefore we have to realize all the assets. So when the assets are realized, third journal entry will be the second, so third one for the assets realized. Realized means sold and realized. For the assets realized, we have to pass bank account data to realization account. We should not put once again asset account because asset account is already being closed. So this bank account at realization, so sale of all assets. Sale of all assets. Assets that has been credited here. So this is a, what is it, selling price. Selling price we have to put. Whatever the selling price, whatever the value it is realized. The value we have realized, that must be debited to bank account. So when you transfer here, we have to put by bank. The realizable value, bank account data to realization. The realizable value. Assets realized we can write. Yes. Assets realized. Realized in the sense sold. This is for closing the assets and for selling the assets. The same manner, the assets have to be paid. So when the liabilities are to be paid, for payment of liabilities, so realization account data to bank we pass. So to bank, realization account data to bank account. This is liabilities paid. This actual amount paid. So this will be given, these two will be given in the adjustment. How much assets are realized and how much liabilities are paid. Not necessarily the same book value to be realized and the same book value to be paid. So for example, sundry creditors may be there. The sundry creditors, so here, liabilities, sundry creditors, bills payable and all that. No, sundry creditors may be paid 10% less. Or sundry payment, namely bills payable paid 25% less. So that will be given an adjustment. What is the real value to be paid and real value to be, real assets value to be realized. Everything will be given in the adjustment. Then we have the expenses on realization. So in order to sell all the assets of the business and the liabilities to be paid, so the owner, namely the owner of the business cannot repay everything. He cannot go to the market and sell everything. Therefore, he has to give it to the agents, the brokers we call it. So these brokers will sell it in the market who are in need of those second-hand assets or third-hand assets, whatever the assets may be. So for them, the company or the business have to pay some expenses, dissolution expenses we call it. So for the payment of dissolution expenses, that is the fifth entry, for payment of dissolution expenses, or we can call it as a realization expenses. Dissolution expenses, so we have to pass realization account debtor to bank. So whatever the expenses, that will be mentioned in the problem. What is the commission that they have to pay to the brokers? So realization account debtor to bank. So realization expenses or dissolution expenses or broker expenses or broker commission, anything may be told. Anything can be told. So now, so whatever the balancing figure, now we have to balance the realization account. So whatever the balancing figure in the realization account is a profit or loss on realization. It may be profit or it may be loss. We cannot say. That depends upon how much assets have been realized, at what price it has been realized, how much liabilities are paid, how much it is paid, whether it is paid fully or it is paid portion wise. So based on that, the difference will be there. Suppose if the credit side is more and the debit side is less, we have profit on realization. To profit, transfer to capital account. They will be sharing it. Suppose if it is loss, this is called loss, and mostly loss on realization will be there, because when the companies are dissolved, what is the reason behind it? The reason behind is they are not able to run the business profitably. That is why the loss comes. That's why they are going to dissolve the business. So definitely, mostly you will have loss on realization only. So loss on realization transfer to, this is a balancing figure. Profit or loss on realization. This is R. Either this or that you will be getting. Loss on realization is a transfer to capital account. Capital account. It's a balancing figure, we call it. Then we go in for the capital account. Next necessary ledger account is called the capital. So the capital have to be paid. They have to be paid. The partner's capital account have to be paid. Capitals are to be paid. So A account, suppose 3 partners are there, A, B and C. So what is the balance, opening balance of capital? So which will be given in the balance sheet. So now what is the, suppose if there is going to be undistributed reserves or undistributed profit in already appearing in the old balance sheet. What is undistributed profit? In the form of reserves. So during the course of the business, these partners might have created some reserves in order to meet out the emergency expenses. So that may be there. If it is there, it's not necessary, compulsory. If it is there, if this business have created those reserves, then transfer the reserves, if any. That's why I write if any. Suppose if there is going to be undistributed profit, the profit earned during the course of the business which has not yet been distributed to the partner's capital account, it will be shown as undistributed profit in the balance sheet on the liability side, if there is any. So P&L account, if any, profit, if any. So it's not compulsory, if any, then that will be distributed in the profit sharing ratio. Then we have A, B, C. We have two we have to make the payment now. So in the same manner here, suppose when there is going to be undistributed loss, P&L account loss, so that will be distributed here. And the balance figure, we have to make the payment to bank, paid. Or suppose if the debit side is more than the credit side, in that case they have to bring in cash. Who? The partners have to bring in cash to bank, balancing figure, if any. If any. That depends upon where it gets tallied, whether on the debit side or on the credit side. This is the debit side, this is on the credit side. That depends. It will be closed. Then finally, we have to go for the bank account. Bank account. So we open it here. Bank account. The third account. Third necessary ledger accounts. So here we have, suppose if there is any opening balance, to opening balance brought down. So by putting this opening balance brought down, which is transferred from the balance sheet, if there is any, then we have to transfer all the cash transactions to the bank account. So thereby automatically the bank account must tally. So what are the bank account here we have in these 2 accounts? Only 2 accounts are there, very easy to transfer all the bank account. What is journal entry here? So we have done bank account debtor to realization account. This is assets realized. So bank account debtor to realization, assets realized. All these are transfer entry. Then next one, we have done realization account at the bank for the payment of creditors. So here by realization. This is assets realized. This is liabilities paid off. Liabilities paid. Then we have payment of dissolution expenses. What is the entry we have passed? Realization account debtor to bank. That is by realization expenses on realization. That's all. Now what is the balance left out? The amount that you have paid to the bankers are released from the bankers. Suppose if the credit balance of the bankers the owners are more than the debit balance, then they will be paid off. When the debit balance is more than the credit balance, then they have to pay it off. They have to pay to the company, or they have to pay to the business. That again depends upon the problem. Sometimes A and B having a credit balance, C may be having a debit balance. So whoever brings in, whoever is paid off, we have to transfer it over here. Suppose if they are going to pay it off, then you write capital account, by capital account, partners capital account paid off. So this must tally at the end. If it tallies, then your problem is correct. Your working is correct. Thereby, you are closing down the business at the end of the year. Thank you very much. This is a concept for preparing dissolution of partners account. In the second part of the dissolution of firm, so we have insolvency of partners. Insolvency means the bankruptcy, completely bankrupt. Bankruptcy, we call it. So under insolvency of partners, we have again, there are two types of insolvency. Insolvency of any one of the partners, partners are all partners insolvent. Okay, there are two types here. So now we see the first part, namely any one of the partner is insolvent, completely bankrupt. So here also the dissolution concept applies. Even all partners insolvent, or any one of the partners insolvent, or if the company wants to close down the business, so we have to apply the same process as with slight changes only in the capital accounts of the partners. So we'll take up any one of the partners. So here also the company has to be closed down because they don't want to continue the business. So under that circumstances, we prepare the realization account. Here also the necessary ledger accounts to be prepared are realization account. Then we have capital account. Then we have the bank account. Then we have only when all partners insolvent, bank account are there. Only three accounts are to be opened, just like a simple dissolution only. Without some slight changes will be there in the preparation of capital accounts of the partners. Now, as far as the realization accounts are concerned, this is completely similar to simple dissolution. Simple dissolution, which we already seen in the last class. Simple dissolution, that is preparing the realization account by transferring all the assets, debit side and credit side, to transfer all assets, which you already seen, by transfer all liabilities. This is a book value, balance sheet value. Then if the assets are realized, by bank, assets realized, then to bank, liabilities paid. Then suppose if you have any expenses, to bank, expenses on realization. Then whatever the balance, if here is a profit or loss transferred. So the credit side is more, we have profit, others mostly we have loss only, loss. Balance if here transferred to capital accounts of the partners. Capital account in profit sharing ratio, which will be given in the problem. The profit sharing ratio is not given, automatically they will be sharing equally between all the partners. This is simple, which we already seen. Next one is we have to go in for the capital accounts where there is slightly different. Capital account. So here, assuming we have three partners, A, B, C. So we transfer the balance, capital balance as usual, to balance brought down, assuming C becomes insolvent. It will be given in the problem. C becomes insolvent. So under that circumstances, there is a possibility of having C having a debit balance of capital account. So here you have to transfer to balance brought down. This is C's capital account. Whereas all others are having credit balances. That is itself is a sign of C, the other partner, becoming insolvent, becoming bankrupt. They want to close down the business because of that. The other partners didn't want to continue that. So here we have to transfer. This is the opening balance which may be shown in the balance sheet. So now transfer all the realization concept over here. What are the realization items? Profit or loss on realization transferred over here. So normally mostly we'll have loss only. To loss on realization transferred to all the partners. The same manner, suppose if you have any undistributed profits lying in the opening balance sheet, that also can be transferred to capital account. If mostly it will not be there because they are going to close down. In the closure stage, there is no possibility of having accumulated profits and undistributed profit keeping idle in the business. So this is a stage. Now we have to first close down the insolvent partner's capital account because so he has to be paid or he has to bring in cash. Even if he is not able to bring in cash, then his loss have to be borne by the remaining partners, remaining solvent partners. These two partners are called solvent partners and C is said to be the insolvent partners, completely becoming bankrupt. The bankrupt means even by selling his private estate, he is not able to realize any amount. He is not able to bring in any cash into the business. That's called insolvent of the business. Insolvency we call it. Sometimes he may be bringing some amount, small amount, by selling all his private assets and after meeting out all his private liabilities. Suppose if he has 1,000 rupees or 2,000 rupees, if he is able to bring, then you put by cash or by bank, like any assets, any cash brought in, cash brought in, if any, this is not compulsory, brought in, if any, if there is, you transfer this here. So cash account data or bank account data to capital account of the partners. So that's all. This is the maximum he can bring in. Now, find out the balance. First, you have to close the, close the insolvent partner's capital account. Insolvent partner capital account. You cannot close all the partners' capital account simultaneously, just like what we have done in the previous simple dissolution concept. So first close the insolvent partner capital account. So insolvent partner is C. So round it off. C becomes insolvent. Now find out what is the balancing figure in his capital account. How much he has to bring in. Suppose if the debit balance is more, normally debit balance will be more. So whatever the balancing figure here, balancing figure, it must be transferred to the capital accounts of A and B. A is capital and B is capital. Capital account. It must be shared by the partners in their capital ratio. This amount will be shared in the capital ratio. In their capital ratio. So this ratio will be transferred. Okay. Now what is the journal entry we pass? A's capital account data, B's capital account data to C's capital account will come. Now open the bank account now. Thereby here capital account we have transferred. The same under here you have to put to C's capital account. To C's capital account is a loss transferred. So this loss of C, otherwise we call the deficit of C, is to be shared by the solvent partners A and B. So the journal entry will be A's capital account data, A's capital account data, B's capital account data to C's capital account. To C's capital. There is deficiency of C is shared by these two fellows in the capital ratio. Or any other ratio specifically mentioned in the problem as per the agreement of the partnership deed, we call it. So thereby this is closed. Then you open bank account as usual, similar to what you have done in the simple dissolution. So you have to open bank account. So bring down the balance if any to opening balance, brought down. Then transfer all the cash transactions that are made in the realization account and capital account. So what are the realization account we have made? So in the realization account we have realized assets by bank, assets realized. So bank account data to realization account, assets realized. Then realization account data to bank, liabilities paid off. We have to pay off the liabilities by realization, liabilities paid. Then we have realization account data to bank, expenses incurred. So liabilities account by realization, expenses incurred. Then if any partner is bringing in cash here, we assume that this fellow, C fellow is bringing some amount, small amount. If it is so, then the entry will be bank account data to C's capital account. Bank account data to C's capital account, if any. It's not compulsory, if any, brought in. Now automatically, so the capital account must get closed. Sorry, the bank account must tally. So if it tallies, that shows that all accounts are closed. The books of accounts are closed after the insolvent of any one of the partners or two of the partners. Not all partners. All partners is simply different. We have to open some more accounts in that case. So thereby, so we can finish off the concept. Suppose if you have any doubt, you can clarify with me. Thank you very much.